I wish I had the benefit of another 24 months to look back on this, but first of all, I'll never call a bottom. I think that that's a really easy way to make a mistake. I do think that in the short term, we probably flushed enough. And this is going to be a year where the anticipation of events is worse than the actual event itself, at least in the market. So we had this lead up to all of the conflict in Russia and Ukraine, and the anticipation of it was really fear-inducing. The same way that we've had this lead up into a tightening cycle, the anticipation has been very fear-inducing. So I think we've flushed enough for now. But here's the thing, even if we de-escalate, even if some of that conflict de-escalates and we've gotten past the most fearful pieces of it, it's not like we're going back to some Hakuna Matata environment where there's no problems, no worries, no headwinds, right? We're still going back to an environment where we're waiting for a Fed meeting on March 16th. We're waiting for the first hike, and we're waiting for a period when liquidity is coming out of the market. So I think that this is a year where the punches are going to just keep getting thrown. That doesn't mean that it's going to be a huge bear market, doesn't mean we're going to end negative, but it's going to be a slog through this.
Yeah, we still got a lot of Fed. We got the meeting, as Liz had mentioned. We got Jerome Powell next week, Steve Weiss, but still you felt comfortable enough to take off your hedges.
Yeah, so I took half off before the show and then half off when it was undeniable that I was going to be wrong short term. And, still have a ton of cash, though. So it's not like I'm fully exposed to the market. I've got beta in the portfolio, so it helps me perform. But my view from yesterday hasn't changed by the market movement today or yesterday. It's just, again, risk management on what is obviously a face-ripping rally, as my friend John Nigerian would likely say. Look, the issues are still there. My scenario still is there, which is we're in a rising rate environment with inflation stubbornly high, and actually that was reaffirmed today in what we saw coming out in the data releases. And then you still have the specter of China. Now, China maybe it doesn't happen for a week, maybe it doesn't happen 2 weeks, maybe it's 3 weeks, maybe it doesn't happen, but the talk will be there. But more importantly than that, the only way to get this inflation down is consecutive rate increases. It's not going to go down on its own. It's not going down with 25 or 50 bips. And what that does, essentially, it slows the economy. So I still believe that in this environment, we need to trade at a slight discount to the market, or at least at an historic market multiple, not where we are right now. Some stocks have more than discounted, lots of that. I own some of those. I own some that are still discounting it, unfortunately. But I just think it's completely bottoms up. And there's going to be, as Liz said, there's going to be painful days, and there's going to be days of elation. And the risk reward just hasn't changed. We're in a trading range, and I'd rather protect my downside than focus on trying to grab for some upside, which I think will be fleeting.